Hello everyone, welcome to the course Financial Mathematics for Actuaries. I am Pramod Kumar Naik. I am going to handle the rest of the sessions. In this week, we are going to learn the topics related to loan repayment methods. Specifically, we are going to learn the loan repayment methods, how to calculate the installment amount, how to calculate the loan outstanding balances, where we will apply the prospective methods and retrospective method, and eventually we are going to learn the loan amortization schedule and the sinking fund method of loan repayment. So to understand more clearly, we need to have a prerequisite concepts. I believe you have already learned this in your previous sessions. The concepts is annuity, in which case we are most likely we are going to use the annuity immediate or ordinary annuity, and I believe you have already learned the calculation of present value of annuity and future value of annuity, and also the effective interest rate, which is very important to understand the loan repayment methods, that is loan amortization schedule as well as the sinking fund method. So how we will define a loan? A loan basically is a sum of money granted to the borrower by the lender with an agreement of repayment the principal amount along with the accrued interest amount. So the interest was basically decided at the time of the borrowing. It is purely on the basis of the mutual understanding of the lender and borrower, but nowadays the interest rate is directly taken from the market interest rate. So the loan basically involves at least a borrower, a lender, and the principal amount is given. The interest rate is stated already, and either it is a simple interest rate or compounding interest rate is also stated, and the loan tenure or the duration over which the loan must be repaid is also mentioned in the agreement. So, a loan can be repaid either one time or in periodic installment. And if the repayment prior to the maturity are only to offset the interest, followed by a final payment to redeem the principal upon maturity, the loan is known as the interest only loan. So, interest basically in the interest only loan, the borrower pay the interest amount is paid first, and at the end of the loan term a lump sum amount has been paid as a principal or to completely repay the loan. On the other hand, if the loan payment includes both payment of interest and partial redemption of the principal, the loan is known as a repayment loan. So each loan payment can be separated into two components. One is the amount of interest, another is the amount of principal. This is very common. Every one of us knows it, right? Upon payment of the installment, the balance of the loan reduces. This happens mostly on the repayment loan. So, what is the amortization method of loan repayment? What do you mean by amortization? Or by amortization, what we understand basically? The most common loan repayment method nowadays is amortization method. Basically, it reduces a given loan amount or the principal through a series of payment over a fixed time span, whereby one account explicitly for a portion of each payment that goes towards the principal and the portion towards the interest owed on the loan. So, in this method, each installment is used to offset the interest incurred over a period and to reduce the principal. So your installment amount will be divided so that some amount will go towards the interest due and some amount will go towards the principal reduction here. And then you can also able to identify what is the loan outstanding balances. That means after some installment payment, if you want to repay all of your amount, all of your uh, remaining loan balances, then you can able to do that only if you know that the outstanding balances. So why loan amortization? How it is important and why for an actuary it is related. So in general, the loan amortization principle or an understanding of loan amortization schedule provides a clear understanding of the cost of borrowing. What is your a cost of your total loan, and therefore you can able to manage your future expenses, meaning that knowing the financial burden of a person of ours, we can accurately plan our future expenses. It also helps to manage our debt. It can help us to compare different types of loans or the opportunity loan options available for us, and accordingly we will choose one which is suitable for our purpose. And for an actuary's point of view, note that the loan amortization is not just about calculating the payment, but rather about managing risk, modeling cash flows, and valuing financial assets and liabilities, and so on. And therefore, it is very important for us to understand the loan amortization principle. Let's understand the loan amortization principle by considering a simple example, and later we will also understand it more formally, okay, putting all mathematical notation into it. But for now, take this example that a loan of 1000 rupees with an interest rate of 10%. Suppose you want to make a three payment. The first payment is 200 and the second payment is 500 and the third payment is rest of the amount to complete the loan balance. How we will proceed? Okay. You want to know the amount owed at the end of each year and the outstanding balances. So, at the end of the first year, that is before the first payment is made, the amount owed including the interest rate is the 1000 multiplied by 1 plus the interest rate, that is 1.10, which is amounted to be 1100. That means after 1 year, if you want to repay the loan, then the interest amount you have to pay is 100 rupees, totaling your loan amount to be 1100 rupees. The outstanding balances after the first payment is made is therefore 1100 rupees minus your first installment, that is 200 rupees that you have decided earlier, okay, and therefore the outstanding balance is 900 rupees. Remember that the outstanding balance is not 800 rupees, it will become the 900 rupees because you are now deducting the first installment from this amount, okay, not this. At the end of second year, before the second payment is made, the amount owed including the interest rate is again the interest rate of this one is added there, and therefore 900 multiplied by 1 plus the interest rate, that is 10%. So it will become 900 multiplied by 1.1 will become 990. So the outstanding balances after the second payment is made, therefore 990 minus the second payment what you have made, that is 500. So this will become 990. Okay. Now you would prompt to think that now the first payment is 200 and the second payment is 500, and therefore the remaining balance is 490, and therefore you need to repay the 490 and close the account. But actually it is not. Remember that the like the interest, the 490 also earn the interest amount at the rate of 10%, and therefore you need to add this amount and then finally close the account. Okay, so at the end of third year, therefore the amount owed is 490 multiplied by 1.10, which is amounted to be 539. This is the final payment you need to make. So what you have noticed here, each time a payment is made, the outstanding balance from the previous payment point is accumulated with interest to the current loan payment point, and the new payment is subtracted from the new outstanding balances at the current point. Now, you have to note one thing, that the amortization principle requires that whenever a payment is made, interest is paid first and any amount remaining is applied toward reducing the loan balance, and therefore your first payment, from the first payment, okay, whatever amount is into, for example your first payment was 200 rupees, but the interest amount was 100 rupees, and therefore 100 rupees will go towards the interest due and 100 rupees will go towards reducing the loan balances or the principal. So therefore, for a payment of 200 made at the end of first year, 100 is interest paid and the remaining 100 is principal repaid. Okay, so you can put it in a table and it will look like this. So this one, this is your initial loan balance, this is the first payment you wanted to make, and this amount is just the 10% of this you are added here, and therefore 1000 plus 100 is the total cost, and in 100 rupees will go towards the interest due, and this one minus this one will give you the principal. So similarly, at the end of second year there will be interest of 90, that is 10% of 900. So the payment of 500 at the end of second year is a composition of the interest payment of 90 rupees and the principal repaid of 410. The outstanding balance after the second payment therefore is equal to 490. This can be seen here in this section. Okay, here you can see it clearly that in the second year, okay, this is the second payment you have made, that is 500, that you have decided earlier. Okay, and now the interest amount has been computed from this, so 90 rupees will go towards the interest due, and from 590 rupees will go towards the interest due, and the remaining amount will be reduced from the principal repaid. So 410 rupees will be repaid towards the principal, and therefore the total loan outstanding balances will become 900, this 900 minus this one, that is this one, which is equal to 490. Similarly, at the end of third year there will be interest due of 49 rupees, that is the 10% of 490. The total payment required to completely repay the loan at the end of third year is the interest payment of 49 plus the principal amount of 490, totaling the 539 rupees. Okay, again it will look like this. Okay, here, right? So this 539 is the total amount or the final amount you have to make if you want to close the, okay, in this example. So this, out of this 49 rupees will go towards the interest due, and the remaining 490 rupees will be directly repaid towards the principal, and therefore 490 minus 490 will be 0. Your total outstanding balance will be 0, and thereby you close the loan. Your loan is completely repaid now. So, what you notice here, the total amount you have just paid is 1239. Okay, 1239, that is 1000 the initial loan amount and the interest amount is 239. So, the interest paid in 300, the second was 90 and the third was 49. So, every time it is gradually decreasing for a total amount of 239 during the course of the loan. Now, you have seen that out of your 1000 rupees loan, if you want to make a 3 payment, first one is 200, third one is 500 and the rest is 539, then your total interest payment is 239 rupees, right? That is, you have already seen it here. So, 239 rupees you are paying, that is the cost of your borrowing. Now, instead of this, you want to make a equated monthly installment type payment. That means every time, okay, all the 3 time you want to make an equal payment. Then how much the installment would be? Then you need to compute the installment amount, that is 402.11. Now, you need to understand how this value comes in. That is the method we want to learn from prospective method as well as from the retrospective method. For our curiosity here, this is basically the total loan amount divided by the present value interest factor for annuity, right? Or you can say here that this is the total loan amount 1000 rupees divided by the present value interest factor for annuity, okay, at n is equal to 3 and I is equal to 10, or you can say that here L divided by A, and this can also be written as L divided by A angle N at I, okay. And then here we know that the present value interest factor for annuity, using the formula, okay, you will get 2.4869, which is equal to 402.11. So in this case, the amortization schedule look like this. So every time the installment should be same here. So every time the installment amount will be 402.11, okay, that the first, second, third, out of which 100 rupees will go towards the interest payment and 302.11 will go towards the reduction of the interest payment, the reduction of the principal payment, okay. And then the total outstanding balance therefore will become this 1000 minus this one, right? This minus this one will give you this one, right? The second year also the installment will be same, and therefore, okay, our 10% of this you have to compute, that will become 69.79 will go towards the interest payment, and this 402.11 minus 69.79, this will be amounted to the 332.33 will go towards reducing the principal payment, and then again you subtract this value from this value, you will get this value. The last payment is also doing similarly, and then you will get the total outstanding balances at the end of 3 years will become 0. So here, how much you have paid? What is the total interest payment? Total interest payment you have made it 206.34. Previously, if you are not making the equated payment, that is, if you are making 200, 500 and the rest, then you are actually paying a higher amount than this, that is 239. But if instead of that, if you like to pay an equated installment, then your cost of borrowing is actually reduced. This is one of the advantage of understanding the loan amortization schedule. And also you can see here that initially your interest payment was high and gradually it decreased over the time, and the principal reduction initially was less, but it increased gradually to complete the loan balances. Take another example which says that construct an amortization schedule of a loan of $5,000 to be repaid over 6 years with a 6 payment annuity immediate at effective rate of interest of 6% per year. Now, using the same principle, you can compute or you can construct this table. This table is known as loan amortization schedule. Here you have seen that this is the initial loan balances, that is 5,000 rupees, and 6% of this is equal to 300, which will go towards the interest payment. Okay, and the installment amount is computed as 5,000 divided by the present value interest factor for annuity, which then equal to 1016.81. That will be same for all the 6 period. Okay, and in this second period, therefore, this is the outstanding balances, and from this you need to compute 6% of interest rate, which will be this one. This amount will go towards the interest payment. So here it is clearly mentioned, interest accrued in the first period is 300, which is this one. Okay, principal reduction with the first installment is this one, that is 716.81, which is this value minus this value is equal to this value. Now the total outstanding balance will be this value minus this value. Okay, that is 4283.19. So interest incurred in the second period therefore will become the 6% of this value, which is equal to this one, that is 0.06 multiplied by this. Okay, the rest of the table, all the values are computed accordingly, and then the value is put here. Now I believe these two simple examples enables us to understand how the loan amortization principle works and how the loan amortization schedule look like. So in the next session we are going to discuss the loan outstanding balances. There we are going to use the prospective method, and also you will see the retrospective method, and we can also see that both the retrospective method and the prospective methods actually gives us the similar answer, and then we will formally understand the loan amortization schedule with some mathematical notations.